Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, Chris Englebert is back with us. He's the founding partner and chief investment officer at Englebert Financial Advisors with our monthly registered investment advisor update. This time we're going to focus on setting up your own firm, and then we're going to get into a number of the monthly charts we take a look at. Chris, it's great to have you back with me. As always, now something very near and dear to you, talking about changing firms, opening up your own firm. What's your best advice when advisors make that move to another firm, whether it's their own or somewhere else?
Sure, Jill. Thanks much for having us. Well, there's three things that I really want people to remember when their advisors change a firm. Advisors change firms all the time. It goes on every day, week, month of the period where advisors leave one firm and go to another. We think there's three things that clients should really focus on. Make sure you have your advisor's personal information. I mean, we give our cell phone numbers to our clients in case they have a financial emergency and they have to get a hold of us, but that also works the other way too, where they can call us and find out what's going on. We also think that people have to understand what's their advisor's role. So in our shop, I'm actually the portfolio manager for all of our clients' accounts. In some shops, what ends up happening is that there's a chief investment officer. So if you like your advisor and he's managing your portfolio, make sure you reach out to him, because the third thing that we talk about when advisors change firms is many times they cannot contact their clients. The clients have to contact them. So we think it's very important that people understand their advisor's role, what they do, and why they may or may not be able to contact them. And if they like them, obviously call them and find out what's going on with the firm, what's going on with their new firm.
All right, now if you're an advisor and you're moving to a firm, that's one thing, but what about setting up your own shop? That's going to be a little bit intimidating.
Yeah, it is a little intimidating, but technology has improved so much in the last 5 years. So the first thing we tell people that are setting up their own shop is focus on your compliance arm. There's a lot of outsourced compliance companies that have come into fruition the last 5, 6 years. You couldn't really have done this 5 or 6 years ago, but they're very good firms that will help you set up your ADV, have ongoing monitoring of your marketing information, and also make sure that all of your information is up to date as well. We also think that you have to interview all the custodians. You have all the major custodial players. There's been some big changes in the last 2 weeks with custodians, and you really have to hone in on what you want your firm's custodianship and relationship to be. And the third thing is make sure you understand what you want, the type of business that you want your firm to do. Rather than being all things to all people, you really have to focus to your firm. And maybe you have an opportunity now that you're setting up your own firm to really dial in on the type of client that you want.
Yeah, we're seeing that on the institutional side too as well, outsourcing so that you can actually focus on investing, which is your primary role. Let's take a look at some charts here. All right, so we thought that October could have potentially been a little bit more volatile. Is it playing out that way? What do you think?
Well, we've had some volatile days, but you can see that the uptrend is still intact. We had a pullback. I have an uptrend line going back to the first of the year. We're bumping up against resistance for the third time. The bearish sentiment is off the charts. There's been some sentiment indicators released in the last week that show this bearish sentiment is as high now, within 1 or 2% of all-time highs, as it was last December. So we think what investors are really losing sight on is what's going to happen with earnings and where do you focus, and whether earnings or not are going to power the S&P to new highs for the year.
Well, expectations are really low for earnings, so even if you get somewhat of a decent beat, that could be the catalyst for the next leg up. Let's take a look at the Nasdaq here. All right, we have the Nasdaq 100.
Yes.
Yep.
So what's happened is there's been a raging debate whether or not we're finally seeing the rotation from growth to value. And so we've seen the Nasdaq continue and power on here after a pullback. But what is happening this week, there's been some big financial firms which tend to be more value oriented, have reported earnings, and the earnings have been really good. So is this the start of the rotation from value to growth? I don't want to count growth out. It's had a very long run. It's done extremely well, but we're going to see some major earnings announcements by large cap growth stocks, and we actually think that that could start to turn the scenario around. All
right, let's take a look at our next chart, the Russell 2000. Now, if we were to get that small cap performance into the overall market, that could be another catalyst too.
Yeah, it could be. I hate to say the Russell 2000 has been obviously the biggest lagger. You can see it's been in a trading range channel literally for the last 6 or 7 months. It's back to the middle of the trading range. We have seen breadth improve for small and mid cap stocks, but it's not powering quite as much as the other indices that are out there. However, there's something called the Santa Claus rally in the small to mid cap stocks, and I think that's going to bear a lot of scrutiny whether or not the small mid cap area can break out. You and I talked talked about it last month, that if we just got a little bit of positive sentiment in the small mid-cap area, you could have a tremendous rally of anywhere from 15 to 20% because they've really been lagging the rest of the market is what's been happening.
All right, let's take a look at our last chart here. The 10-year Treasury note. It's so interesting. By the time you're here in November, we will have found out if we got another rate cut or not.
Yeah, exactly. So this chart shows you that the big story this year has been the decline in interest rates. Again, we think there's a couple things going on. The recession narrative, a lot of people are focusing on saying, well, because of the recession, that's why interest rates are going down. We think there's a whole nother read to it, that you have so much international debt at negative interest rates that international investors are coming back going, hey, the 10-year Treasury, even at a 175, really looks good. But you can see down on the right-hand corner here that we bottomed. We had a sharp spike back up to the 190 area. We pulled back. We got a higher low. We think that what's going to happen is that once investors realize that the recession narrative has been put to bed for the next 2 or 3 quarters, that you could see interest rates come back up. Again, last month we showed a 2-year chart back to 2016 showing how low rates went. And then last September, October at this time, if you remember, the 10-year was at a 3.11%. So again, we think that there's a little bit more risk in the bond market than there is at the stock market. And you and I talked about this last time, and it's been all over Twitter about how the fact that the 10-year yield is below the dividend yield on the S&P 500, and there's been some very interesting statistics that show how positive the S&P 500 return has been for the next 12 months when that situation happens.
Well, where else are you going to put your money if you want to get some kind of yield, right?
Exactly.
Right, Chris, thank you so much for joining us as always. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.